Hello, if you're new to the channel, welcome. In this video we will talk about free cash flow. Let's see what it is, what it's for, and how it can be calculated. What is free cash flow? Free cash flow is nothing more than the money left over in a company at the end of the period in question, after discounting operating costs, i.e. the money needed to support the business, and capital expenditures such as maintenance and asset depreciation. Simply put, is a company's available balance. What's it for? Free cash flow can be used by a company to pay dividends, take down debt, buy back shares, make acquisitions of other businesses, or reinvest in it itself. In this channel, we use the average free cash flow to determine various fundamentalist aspects of a company, such as get an idea of the size of a company's debt, see if the dividends are safe, and finally to try to get an idea of the value close to the fair value of the share. Debt. We can compare the average free cash flow with a company's total debt, and so we have a notion of how long it will take for the company to generate enough money to pay off all its obligations. For example, if a company has a debt of 100 million, and the average free cash flow for the last 5 years is 10 million, it means that if nothing changes in the future, it will take about 10 years to generate enough flows to take down your entire debt. I personally like that value remains below 5. Dividends. Many investors love stocks that pay a high dividend rate, so several companies increase their dividends to attract investors. However, it is necessary to understand if the company can afford them in a sustainable way, and for this we can use the free cash flow average. The idea will be to calculate the total amount of dividends paid by a company annually, and then compare this amount to the average free cash flow of the last 5 years. If dividends represent, for example, 200% of this average, we can immediately ask ourselves if the company can sustain this dividend rate much longer. I like that this value remains below 100%, and that on a portion of the free cash flow for the company can shoot down debt, repurchase shares, and make acquisitions of other businesses. Let's go to an example. Coca-Cola has a current dividend yield of 3.08%. If we multiply this value by its current market capitalization, we see that it pays a total of 8 billion annually in dividends. Comparing this value with the average free cash flow of the last 5 years, we see that dividends consume most of it, which may not be ideal. Price. All investments are the present value of all free cash flow generated in the future. That is, a business is worth all the balance it will generate in the future, brought to present value. For example, if a family member tells you that he gives you €1 a year for the next 10 years, how much are you willing to pay that person today to make that happen? €9? Maybe it's not worth it. €3, for example, already seems a much more appealing business. The question is how much we're willing to pay. Investing in a company is the same. Returning to the example of Coca-Cola, if we divide the market capitalization, i.e. the total price of the company, by the average free cash flow of the last 5 years, we reach a multiple of 30x. In other words, if nothing changes in the future, Coca-Cola will take about 30 years to generate what it currently costs. It would be as if we were paying €30 to our family member to receive €1 a year forever. I generally like to use a multiple of 20x, i.e. in this case Coca-Cola should be quoted considerably below the current value. However, different companies deserve different multiples. For example, higher growing companies deserve higher multiples, and vice versa. For example, if that same family member asked you for €5 and in return offered you €1 a year for the next 5 years, would you take that deal? As a profitability of 0% would be losing to inflation. What if he offered you €1 in the first year, 2 in the second, 3 in the third, and so on until the 5th year? Suddenly it made a much more appealing proposal, right? So growth is a very important factor in trying to understand how much a company is worth. How to calculate free cash flow? To calculate free cash flow, we subtract capital expenses from operating cash flow, which is the money generated by a company in its regular activities. I hope you enjoyed this video. The numbers used are rounded values, and the opinions given are just my personal perspective. It is not a recommendation. Leave suggestions in the comments of financial indicators that you would like to be covered in the next videos. Thanks for watching and good business.